friends, and welcome back to Market Shares. I'm your host, Tony Blodgett, and as promised, I have back with me to do an overview and breakdown of the Fed meeting, Mr. Dan Habib. Dan, thanks for coming back onto Market Shares so we could break down what the Fed did back on September 17th.
Yeah, Tony, thanks for having me. Always a pleasure.
Yeah, I mean, so I just got to say, for those that didn't watch the episode that we did right before the jobs report came out the week before the Fed meeting, and then we kind of, gave some predictions on what was going to unfold that week of the jobs report. And I got to say, Dan, you freaking nailed every single one of those predictions. And one of the questions I had asked you during that episode is, do we think Friday of the jobs report or maybe that Monday would maybe be the best day to pick up on, the best interest rates, knowing that as we moved into this Fed meeting, there could be some additional volatility. And I think a lot of people locked their loans in ahead of the Fed meeting. I think that was your guys' recommendation. I do want to talk a little bit about what the Fed said. I got a couple questions here. I'm sure you'll give us kind of your analysis, but, we're recording this here the following week. Today's September 23rd, so it's only been a few business days since the Fed did their quarter rate point cut. And we have seen rates, deteriorating, getting a little bit worse since then, which is what a lot of people predicted. But I don't know that it's happening for the same reasons that maybe it's happened in the past. So I'd love to unpack what's going on currently with rates, and then maybe we can talk about a longer term projection on what you think's going to happen here. So I just want to set the stage with kind of what we want to cover here in the next 20, 25 minutes or so.
Yeah. So, it was a fun call we did last time, and we did make some good predictions. Listen, sometimes you get a little lucky, right? But everything was pointing to some weak labor market numbers. We thought that openings were going to be weak, and they fell even more than I had anticipated. They were very weak. We had ADP, which wasn't a very strong number. And BLS, we said we thought June was going to be negative. Sure enough, it got revised to negative 13,000, and that the BLS number was going to be weak. It was only 22,000 for last month, and that the unemployment rate would go up to at least 4.3, maybe 4.4 if we got lucky. It went to 4.3. So I'd say we did pretty good on those, and we did talk about how, listen, the market's forward-looking. So after that, we anticipated we'd see a nice move lower in rates, and rates had already moved lower in anticipation of the cut. And I think you had asked me, is it a good idea to wait and see if rates get down further? And I said, I don't think I'd be greedy. You don't know what could be said at the meeting. You don't know how the Powell press conference is going to be interpreted. And we've already seen the move be priced in. So probably a good idea to lock ahead of that. And it looks like that was some prudent advice. Now, that doesn't mean that I don't think rates can continue to be attractive and move lower. But as you stated, since the Fed meeting, rates have moved up a little bit. Now, nothing crazy. The day of the Fed meeting, before we saw the Fed at 2 o'clock announce the cut, the 10-year got down for a little bit, actually, just under 4%. Here we are today, it's at like 4.11. So the 10-year has moved up about 11 basis points or so since the Fed cut rates. So why is this happening? Well, first things first, Tony, let's break down, and I have a slide just to kind of walk through this, what happened at the Fed meeting. So at the Fed meeting, the Fed meeting, they have always two components, which is the statement and the press conference from Powell, but also every other meeting has the Fed's summary of economic projections, which this one had, which gives the Fed's kind of outlook on where they see things going in the economy. So everybody anticipated the Fed was going to cut 25 basis points. So yes, it's true. The Fed's not cutting mortgage rates. They're cutting a very short-term rate. But as I showed you on the last podcast, over time, historically, they trend pretty well, and usually it has some good influences on mortgage rates coming down. People saying that rates have gone up after the cut. I think they're being a little myopic in their view, because rates came down 0.3% on a 30-year fixed rate mortgage in anticipation of the cut. And if you look at their statement, almost all Fed members wanted a 25 basis point cut, but the new Fed governor, Mirren, appointed by Trump, he wanted a 50 basis point cut. So he was the lone dissenter. And now the Fed funds rate is in a range of 4 to 4.25. That's how they do it. But the effective Fed funds rate is 4 1/8. So at the press conference, Powell said that policy is clearly restrictive. And he even said that today in his comments at the time of recording here on the 23rd. He also spoke this afternoon saying he still thinks policy is moderately restrictive. Why is that important? Well, if Powell thought policy was near neutral or very, very, if any restrictiveness in their policy, it would mean that he doesn't think they have room to cut rates further. But by saying they're still clearly restrictive or moderately restrictive, it implies that the Fed could cut a couple more times before getting to a neutral level. He also said that economic growth has moderated in the first half of the year, and previously their focus was mainly on inflation. The Fed has a dual mandate. They want to see stable prices or 2% core inflation and maximum employment. They don't want to see the unemployment rate go too high. They've been focusing on the inflation mandate for a while now because labor has appeared to be strong, even though we've been talking about how a lot of the numbers from the BLS have just been BS. But inflation has been the one that's been more out of balance and out of whack and running well above their target. So now he said there's more downside risk to labor. And that's the real reason why they cut. You have the revisions from the jobs data, the weak jobs reports that we've been seeing, June being negative, July not that great, September 22,000. And then on top of that, the icing on the cake was the QCEW data, which showed that for last year, the BLS overstated job growth by 911,000 jobs, which means if you look at total job creations, they overstated job growth by 52%. So not only is job growth right now weak, but where we're coming from was a much weaker place to begin with than they previously thought. And that's why the Fed said, we need to put more attention towards the labor market portion of our mandate and cut, because when things get sour in the labor market, it usually happens pretty quickly. Now, a lot of the Fed, they talk about how the break-evens have been lowered. What does that mean? It means the level of jobs that need to be created to keep the unemployment rate stable. Why are they saying that that has come down? Well, you have job creations on one side, which it's been a lot weaker, but on the other side, the supply of labor has also gone down because of big changes with immigration. So a lot of people arguing that, hey, we don't need to see 150,000 job creations a month like we used to see the unemployment rate remain stable. Now it's at a lower figure. And while that may be true, job creations are still very, very weak. And if you start to see a little bit of a turn up in firings, you don't have the absorption from the job creations. And that's where the unemployment rate could turn higher and turn higher in a hurry. And the Fed wanted to get ahead of this. In my opinion, I still think they were late. They should have cut in July, but they're looking at old and lagging data that's incorrect from the BLS. And boy, on that note, we just heard from the Chicago Fed president. He said that, and that's Austin Goolsbee, that because of issues with the jobs report, he created, or the Chicago Fed created, their own newer real-time unemployment rate indicator. They call it CHURN, the Chicago Fed Unemployment Rate Nowcast. And this is going to be something, I believe, on a weekly basis, where they're not just looking at the BLS data. They're looking at ADP. They're looking at the job posting sites like Indeed. They're also looking at even things like Google Trends and people searching for jobs and unemployment and things of that nature. So it's supposed to be a much more real time and give you a more holistic view. We'll see, because they are estimating that the next jobs report, which I'll get into because I think that's going to be like the most important jobs report that I can remember, which is on October 3rd. They think the unemployment rate is going to remain stable at 4.3% based on their models. We'll see how they measure up there. But getting back to the Fed meeting, he said that inflation has moved up but remains elevated. But I thought there was a clear shift in Powell's tone the last couple times he's spoken, where he was deathly afraid of the tariffs, and now it seems they're more and more confident that the tariffs are going to be one-time price increases, and that when you remove the tariffs, really inflation's not so bad and a lot closer to their target. And he even estimated that the tariff impact, which he thinks will be short-lived, is accounting for 0.3 to 0.4 of an impact on core inflation. Well, most recent number is 2.9%. So that would be 2.5%. Remember, their goal is 2%. If you remove the tariffs, it's 2.5%. And we know the housing services, rents and such, it's way overstated in these reports, accounting for probably another 0.2 to 0.3% as well. So, hey, you remove some of these things and you're not that far off as far as your real inflation, not these one-time price increases from their target anyway. And boy, one thing that this meeting really showed is that the Fed is more divided than any time that I can remember in my professional history. So The SEP, the Summary of Economic Projections. This is where the Fed members project where they think the unemployment rate, inflation, GDP, and of course, the Fed funds rate is going to be. So for this year, they think the unemployment rate is going to go from its current level of 4.3 to 4.5%. They think core PCE, which right now is 2.9%, is going to end the year a little bit higher at 3.1%. So they're anticipating that to happen, mostly due to tariffs. They think GDP is going to be 1.6%. Now, compared to their previous projection in June, it's gone up from 1.4, but that's still pretty anemic growth that they're forecasting. And then this is something everybody was watching. What is the Fed projecting with their dots plot chart, which shows where all 19 Fed members anonymously think the Fed funds rate is going to be this year? Well, it showed a lot of division. So one Fed member said they want to hike. Now, I don't think they really want to hike, but that was them showing their dismay for the 25 basis point cut on September 17th and that they disagreed with it. However, when it came time to vote on the cut, they fell in line with the Fed chair. Then you have 6 Fed members that want no more cuts this year. You have 2 that want 125 basis point cut, and then you have 9 that want 2 more 25 basis point cuts. And then you had one, and we can all guess who this is pretty accurately. It's Stephen Mirren, who said he wants 125 basis points more in cuts this year. Now, that would imply a 75 basis point cut at one of the meetings and a 50 at the other, because there's 2 meetings left this year, October 29th and December 10th. So, Stephen Mirren, his views are a little bit different than most of the other, or if not all of the other Fed members, because of where he believes the neutral rate of the Fed funds rate to be. He thinks it's much, much, much lower. He wants to see the Fed funds rate down in the 2 to 2.5% range, where most Fed members think neutral is closer to 3. Some think it's above that. It depends where you think R star and the neutral rate is for the Fed funds rate. And listen, that's a moving target, and it's something that people have opposing views on. But this Fed was very, very divided. And, Tony, after we spoke last time, I had showed this chart, how last year, at the end of 2024, September 18th, the Fed cut 50 and rates moved up. And then November they cut, December they cut 25, and rates moved the other way. And everybody's saying, see, Fed cutting doesn't help mortgage rates. And while it's not a direct correlation, people forgot that the markets are forward looking and rates moved down almost 0.75% in anticipation of the September cut. And then what happened? Well, they cut. Rates were stable for a couple of weeks. And then October 4th, what happened? We got the monster September jobs report that really started to send rates higher. Same thing happened in November. Same thing happened in December. As I mentioned, we're learning now that 52% of the jobs they said happened last year weren't even real, but that had real consequences for mortgage rates and for us in our business. And that's why it kind of pisses me off when you see some of these inaccuracies, because it has real consequences on our business. But over time, and I showed this, that, hey, mortgage rates, it's not perfect. It's not in lockstep, but they do correlate very well to the Fed funds rate, which is why I thought that this time around, we would see it help mortgage rates. And barring blockbuster jobs numbers, I think rates can remain attractive for a prolonged period of time. Now, here's a chart that I pulled showing you the 10-year. And this was August 22nd. The 10-year was at 433. This is when we learned at the Jackson Hole, Wyoming meeting, where Fed Chair Powell telegraphed for the first time the Fed was going to cut on September 17th. 10-year was at 433. Right before the Fed announced rates were cut 25 basis points on the 17th, the 10-year, it actually dipped beneath 4% for a little bit, but it was in the very low 4s. So clearly, the market was pricing in, even on the long end, the rate cut. And mortgage rates came down over that same period of time, 0.3%. Now, since the Fed cut, have rates moved up a little bit? Certainly have. One of the things that hurt us was the reason why the Fed cut rates was because the jobs market was showing a lot of weakness. And while we didn't get another jobs report, we got an initial claims report that next day, or that day, I should say, and what it showed is a very low level of initial jobless claims. And the previous week was like 264,000, the highest we've seen in a while. It dropped down to 231,000. So the Fed's cutting because the labor market's showing weakness, but then you got what shows to be less firings and a little bit of a stronger labor market, at least from that report. But it's also the reason why I'm saying I think this jobs report on October 3rd is going to be absolutely critical. And I really think it is going to dictate what the Fed does at the last two meetings this year. If we get a weak jobs report, weak job creations, the unemployment rate either stays the same or goes up to 4.4, I think that solidifies at least one, probably potentially two more cuts this year. If we get out of nowhere a strong jobs report, Tony, and you see strong job creations, you see the unemployment rate go to 4.2, boy, that really throws a wrench in potential cuts for the rest of the year. And we could maybe not see them. And that will also impact mortgage rates negatively. Remember, last year, Fed was cutting. And the thing, in my opinion, that really hurt us was those blockbuster jobs numbers. This year can be different so long as we continue to see weak labor numbers, which it doesn't seem to me that there's any reason that should change. We're seeing a lot of weakness there in the labor market, but BLS hasn't exactly been accurate historically.
Yeah. A couple follow-up questions, and you make a really good point. I hope that we don't repeat what happened last year and follow, what should have been a good Fed decision to lower at least a quarter and follow that up with a strong jobs number to really reverse things. And I guess we'll have to wait until the 1st of October to see exactly how that plays out. On the 3rd. Okay, perfect. So I want to talk a little bit about Stephen Mirren, though, because it seems odd. Like, I think everyone's thought is okay, this is, Trump had an opportunity to replace a Fed member, and so they kind of planted this guy into the Fed, who still, from what I understand, is employed by the White House, and it really calls into question this separation of, the Fed independence issue, right? And it would seem to me like, and maybe Stephen Mirren is the right choice. I don't know a whole lot about him, but is it odd to you that his dissension was so significant, not just to be the only dissenter suggesting a 50 basis point cut, but also the dot plot, outlier?
Yeah.
It's almost like, it's just screaming like, I'm here to impact the Fed and try to drive down rates. I'm only one guy, but I'm a one-man army, and I'm going to make it known that I'm here to kind of disrupt things. Like, is that what it said to you?
Yeah. No, it's a great point. So let's unpack this, right? So first off, the president, whoever is in office, always appoints the Fed governor. So throughout history, forever, the president is always going to appoint Fed governors that are like-minded thinking to him, that want to accomplish goals in the ways that he sees it. So that's not new, right? He wouldn't have been able to appoint Stephen Mirren if Adriana Kugler, the Fed governor, didn't resign early because she wanted to go back to teaching at Georgetown, and she wanted to leave before and get to Georgetown before the school season started. So that's why Trump was able to put Stephen Mirren in there for the 4-month vacancy. Now, listen, I think I can certainly see why people ask questions like, well, he's still employed by the administration. He's the head economist at the CEA there, and he's kind of holding this role at the Fed. But I could see that. I don't know how much that's going to change things because he's already appointed by the president anyway, and it's for 4 months. So if it were you or I and you said, Dan, I need you to quit your job because you need to help me for 4 months and fill this vacancy when you're going to go right back after, I could see why that could be a little bit difficult, but I could too see and be fair and see why that could raise some eyebrows. Now, to the other point you made, I think he handled the situation so poorly. I mean, I think President Trump did as well because, listen, you want to clearly see rate cuts, right? The independence of the Fed is very important. It's the hottest topic that you're seeing on headlines. Why would you come out as President Trump and say we'll have the majority at the Fed soon? I mean, that's just a dumb comment. But then you put Stephen Mirren in there, and Stephen Mirren would have been smart to just vote 25 at the first meeting. Or even if you were going to dissent, which I think was a dumb move because it's just supporting the noise that's out there in the media, why would you put such an unrealistic dots plot out there showing 125 basis points of cuts? It proves the point almost of what people were saying in the media about it and supports it.
Right.
But I will say this, Stephen Mirren is a brilliant guy. Okay. And if you watched his interview and read his paper on CNBC yesterday, and it's a very long, very technical paper, there is reason for why he believes, and I truly do believe that he believes the neutral rate's much lower and why he thinks the Fed has so much room to cut. And it has to do with all of these economic theories that I won't bore you with and his interpretation of, based on events happening, why the neutral rate's much lower and why they have so much more room to cut. But, he's a smart guy. And if you read through, he certainly makes an argument for it, whether you agree with it or not. But just optically, I thought that was poorly handled.
Yeah, well, I do actually feel better knowing that he supported that decision with some logic, it sounds like, at least his take on it. So we'll try to find that article.
It's highly, highly technical. Unless you're like a PhD economist, it's going to be hard to understand because he's talking about all kinds of economic theories and such. But I will say the short of it is that he thinks that the neutral rate is much, much lower because of something called R star, where you take the rate of inflation and you add R star, and that'll give you where the neutral rate is. He thinks it's like closer to 0 as far as R star, where many other Fed members think it's 0.75%. But he has reason and theory to back up a lot of his thoughts. So it's not like it would be one thing if he was just in there saying, hey, president wants to see rates at this, like, let's just cut. He has economic theory. He seems like a very bright guy, but I thought, knowing all this is out there, why would you approach it in that way? It just was stupid to me.
Well, I'll be doing some research. I want to at least find some videos or maybe interviews with him that you mentioned, and if I can find those, we'll link them in the show notes down below. A couple other questions that came to mind as you were kind of giving that overview. I mean, don't you think, knowing now that the jobs numbers were overstated by, I think you said 52%, and obviously that information was known to the Fed before this decision was made. But let me ask you this, Dan. I mean, had those numbers been stated accurately throughout the year, don't you believe that the Fed would have taken more action earlier and probably would have resulted in much more than just a 25 basis point cut? So I wonder why they didn't take the approach of like, shoot, we have some catch up to do here, despite, the fact that inflation is, doing what they expect it to do. But just on the jobs data alone, they would have probably cut a couple times, I would think, leading up to this. But I mean, what's your take on that?
It's tough because while the job creation data has been weak and there was all those revisions, the unemployment rate is still relatively speaking low and what they consider near maximum employment. So that's not like, it's certainly concerning to them, the weakness they're seeing, but it's not like flashing alarm bells because the unemployment rate's still well behaved. Now, I think that's being masked because remember, the unemployment rate is the number of unemployed people divided by the labor force. The labor force is being dramatically reduced because of changes in immigration. So that's why they say the break evens are less, but it's just masking that there's very little hiring and very little demand. And right now, companies are holding on to workers, but boy, if they start letting them go, the unemployment rate can go up fast, and then that could lead to a recession. So it's something they need to be cautious about. But I certainly could see the argument for, hey, now knowing the jobs data has been so weak, why didn't you catch up? Because you probably should have cut in July. And here's the reason why, is because while that unemployment case is there, the jobs market's fragile, it's weakening, they still are very, very worried about inflation. And of course, they're getting more comfortable with the idea that inflation is being impacted temporarily by the tariffs. It could be a long time. It could be, 6 quarters. It could be 4 quarters. I don't know. It could be, who knows how long that's going to be in there, because tariff impact, I believe, will be one time, but not all at once. Remember, there's still huge trade deals out there that are not set, whether it's China, India, right? So once those are set, okay, then you'll have the increase, and it's one time, but it's still going to be in the numbers for a while. And remember, their goal is 2%. We've been running above that for many years now. They still want to show to the markets that they are, really going to get it back down to 2%. They're not giving up on that side of the mandate or raising their inflation target. So it's a balance, right? Where, right now it's a hard spot for them because normally these things don't move this way. Right now, you have inflation going up and the unemployment rate potentially going up. Usually they're almost like opposing forces, right? A little bit, right? Now, right now, their inflation side of the mandate actually would say to potentially hike rates, while the unemployment rate side is saying to cut rates. So I don't think that they felt a 50 basis point cut was warranted because they don't think the labor market is like dire straits yet, and they still are worried about inflation. But they thought they had room to cut because they're still restrictive, and I think they think that there's risk to the unemployment rate. So let's start getting ahead of it a little bit and see how things shake out.
Yeah, I think it feels to me in that explanation that inflation is still the primary driver of Fed policy, and then they acknowledge the weakness in labor. It's like, hey, we're gonna acknowledge that, give you the quarter there, but we're still probably more concerned about inflation, even though they're caught in the middle. It's probably still heavy on inflation.
The way they explained it is that inflation was their primary focus, and when people ask the Fed, and I think this makes sense almost, right? Like when they ask the Fed, of your dual mandate, which is more important, labor or inflation? And what they said is that they're both equally as important, but we look at which one is more out of balance. It's almost like, Tony, like if you have two kids, right? Both of them are important, but if one of them's really acting up, you're going to have your attention on that one that's really acting up right now, right?
Sure.
So I think that that's kind of how they are, but I think they should have had, now they've said, hey, the risks have come more into balance, which means they're not just looking at inflation, they're looking at labor and inflation, which is why they cut. But they certainly should have been more attentive to labor earlier on. But they're looking at old data, and that's why they haven't. And we're starting to see a little bit of a shift in the Fed and incorrect data from the BLS, where I mentioned Austin Goolsbee. He has this now more real-time labor market unemployment rate indicator. We'll see how accurate that is. He thinks the unemployment rate stays at 4.3 in the next jobs report, which is for September. But also, I want to just read a quote from Fed Governor Michelle Bowman, who she's really done a bit of a 180, but she said something very smart in her comments just this week, where she said, a strict interpretation of data dependence, which the Fed's data dependent, right? It inherently is backward looking and would guarantee that we remain behind the curve, requiring us to overcorrect in the future. And by the way, one of the main reasons we have boom bust cycles is because the Fed's looking at old lagging data they always have. They wait too long, things overheat, they hike rates too late, okay? They send us into a recession, and then they start cutting rates too late as well. I mean, it's literally boom and bust caused oftentimes by the Fed. I mean, heck, just look at a chart of the Fed funds rate in recessionary periods, and you will see the correlation, right? And then she goes to say, I think we should consider reframing our focus from overweighting the latest data to a proactive, forward-looking approach and a forecast as to how the economy is going to evolve going forward. Amen, right? The Fed should stop looking through the rearview mirror and looking through the front windshield. And by being solely data dependent, you are going to be behind the curve because data that you're getting is backward looking and also oftentimes, as we know, incorrect from the BLS.
Yeah, 100%. Well, Dan, I want to be respectful of your time. I got two other quick questions or comments. Typically, I don't want to say typically, but a lot of times when the Feds do a rate cut, it's one in a series of rate cuts. But almost always. But one of the things that the Fed said, and I'm curious if this landed on you, was that this was kind of framed as a risk management cut.
Yep.
Like we're acknowledging the labor issues. It's kind of like we feel like this is a risk. So to me, that doesn't indicate the first of potentially many. It's like we're going to put this in place as a risk management, and then we're still just back to this data dependent, watch the numbers, et cetera. Is that kind of your similar take on that?
I think the reason why the Fed usually cuts in like a series of cuts or hikes in a series of cuts is because what the heck is 125 basis point cut going to really do, right? It's not going to be that significant or change much. So, I think it was important for the Fed to shift here. The Fed always says things like, listen, no meetings on a preset course. We're going to remain data dependent, even during where they had these strings of hikes or strings of cuts. It's not like they said we're going to hike at the next 7 meetings per se in most cases, right? So I do think that they did this as percent, but he did get asked the question, and he said, "Yeah, you could look at it as a insurance cut or a risk management cut." But if you look at the Fed dots plot, I think the median amount of cuts the Fed's projecting is 2 more this year, and almost all Fed members still think that the Fed is restrictive. So they have room to cut. They want to make sure inflation is not going to go crazy, but the main thing is going to be the jobs data, and if we get a very strong jobs report for whatever reason on October 3rd for the month of September, it could be one and done. I don't think that that's going to happen, and I think the most likely path is that we're going to get one, if not, I think probably 2 more cuts this year. But I don't know. I could see why people would look at that and say, but I think that they want to continue to cut so long as the jobs market doesn't surprise them, in my opinion.
Yeah. Last question. I just want to go back to this immigration stat. So the number of available jobs and the number of people seeking employment. It sounds like,
Well, it's not available jobs. It's the labor force.
Okay.
Right. So you have the unemployment rate. It's a ratio. It's the number of unemployed persons divided by the labor force. So that's like, how many people are unemployed divided by the people that they consider potential workers.
But the labor force has been going down because of immigration, meaning there's less labor force. But the question I have about this, Dan, is when I think about immigration, the first thing that comes to mind is all of the illegal immigration that has been stopped as a result of the focus on the border and closing the border to illegal immigration. But illegal immigration wouldn't really be represented in those stats, I wouldn't think, right? Because these people are
I'm not so sure about that. I think a lot of those people were being counted, and now they're not being counted in the labor force.
Okay, because I think the other one would be the H-1B1 changes and some of the other, even these.
Well, that'll definitely have an impact, which will certainly be counted, right?
Right.
Where those of you that are not familiar, they increase the cost for H-1B visas, where you get people from other countries that are presumably going to really add to our economy here. They're smart, maybe they're doctors, whatever it may be, right? In healthcare service, and the cost for that visa was, I don't know, somewhere between $2,500 and $5,000, maybe, or $4,000. Now they just raised that cost to $100,000. So that is putting a big tax on bringing talent here. Some people are looking at it as like, I think the way it was presented is it's to open those jobs for Americans, right? But then other people are like, well, this was our opportunity to steal some of the best talent from around the world and bring them here to contribute. And now you're putting a huge 100,000 tax that probably won't make sense for the employer to do, because a lot of these individuals are getting paid 50 grand a year or whatever it may be, right? So, but what it will do is probably cause some less legal immigration too.
Yeah, absolutely. Well, and I think the biggest cohort of those individuals is in the technology space, right? I mean, a lot of tech employees. I mean, I'm up here in Seattle.
A lot of people from India, a lot of people from India and stuff like that. Yeah.
Well, interesting, Dan. Well, look, I really appreciate you taking the time. I know we just kind of carved out a few minutes here for you to jump on, but given this breakdown is so helpful to our audience, and I always look to you as our guy in MBS Highway as our primary source of, kind of what's going on in the market. So it means a lot to me that you took this time to come back and do this kind of unpacking of this.
It's been fun.
Yeah, it was a great series of calls. And look, a lot of people are paying attention to this. I mean, this means so much. We've been in such a difficult time in the mortgage space for the last 3 years, and I think people were looking to, kind of these, this end of 2025, like, do we finally get that reprieve? And it doesn't sound like it's going to just be as easy of a go, but it sounds like as long as we continue to see moderate inflation and some weakness in the labor market, we should find ourselves. I even saw an article today that Fannie Mae, I didn't read the whole article in fairness, but that Fannie Mae is predicting now by, deep into 2026, rates under a 6, in the high fives. So it sounds like we're starting to talk high fives.
Yeah, well, our forecast at the beginning of the year when rates were, like 7 and somewhere between low to mid 7s was 6 and an eighth on a 30-year fixed rate mortgage, which I'm happy to say we did hit.
Right.
But part of that thinking was that the mortgage spread was going to come down too, right? Like you'll notice that the 10-year was actually lower last year, but we had like similar rates. That's because the mortgage spread has actually come down, which is the premium above the 10-year for 30-year fixed mortgage rates, right? So I hope we're wrong. We said the spread was going to come down to 2.25 from 2.80 at the beginning of the year. It has, but there's a potential for that to continue to shrink. And as you mentioned, the October jobs data coming out, September jobs data, October 3rd, that's going to be critical. I think if we see weak figures there, we can continue this run. Hey, it's going to be so important, man. We might have to do another one of these to break down the jobs data.
I think so. Well, so just real quick before we wrap. So are you saying that the spread right now is around 2.25?
Around 2.25, but we could be like, that was our target, but I hope we're wrong and that the spread continues to narrow. Because
isn't the historical number like 180 to 200, more in that range?
160 to 200, yeah.
Okay, yeah. Okay.
Yeah.
Well, that would get us there. So, I mean, that would put us under 6, I think.
But
so,
I think we could get, I think with some luck, we continue to see weak jobs data, the inflation numbers don't go crazy. The Fed, continues. We price in the Fed cutting 2 times this year. I mean, I think it's feasible to say that we could see a 6% 30-year fixed, and there's the potential if that spread narrows to get under 6, maybe very high 5s. I think the key is like, I think most people in the mortgage business would be happy with low 6s. It's just got to stay there, right? Like we can't have this like week period, 2-week period, and then rates
Right.
go up because listen, it's great for refis, right? We're seeing refis spike. Those people that are on it are capitalizing and they're bringing in business. But with a purchase, it doesn't work like that, right? A refi, you either get solicited or your relationship calls you, hey, it's time to refi. Yes, no. With a purchase, we want to see more purchase business, but that takes more time. Rates come down, the consumer finds out, then they start the shopping process. All while they're shopping, rates have to remain low. So we need a prolonged period of low 6% rates I'd be happy with. I don't think it has to get to, under 6. 6%, man, that unlocks like 4 refi opportunities. And I think that unlocks a lot of purchases so long as it remains there for a decent period of time.
Yeah, we need some consistency. Well, Dan, thank you so much again to our audience. Thank you for tuning in to Market Shares. If you think we should have Dan back in the future, give us a like, give us some comments. Let us know that you love what Dan's saying. He's my go-to for this sort of information, and he's been a great friend to the show. For those of you listening and that watch every single week, again, thank you. Consider subscribing. But more than that, tell people in the industry about Market Shares so we can continue to get our name out there. And I will see you guys next Friday. Take care.
Take care, everyone.